Imagine, for just a second, right, a massive, completely climate-controlled warehouse sitting somewhere in, say, the Pacific Northwest.
Oh, yeah, like one of those sprawling, nondescript concrete boxes.
Exactly, just a giant box. But inside, you have literally billions of dollars worth of state-of-the-art artificial intelligence processors. I mean, they are stacked on pallets, wrapped in plastic, and they represent the absolute pinnacle of human engineering right now.
The digital ambition in those rooms is just staggering.
It really is. And hyperscalers are projecting, I mean, they're telling us they will spend up to $690 billion on exactly this kind of infrastructure by 2026.
Which is, I mean, it's a gold rush. It completely defies all known financial gravity.
Right. But then, you pan the camera out, you look at how those physical chips actually get to the data centers, or how the massive cooling systems are shipped across oceans, or just how the energy to run them is actually secured.
And the illusion shatters.
Yeah, suddenly this pristine digital future is currently waiting on physical cargo ships that are quite literally actively dodging missiles in the Strait of Hormuz. We have 41 daily transits acting as this severe geopolitical bottleneck. It's fundamentally rewiring how energy and materials flow to Europe and Asia.
And it's basically the ultimate paradox of our current economic moment.
Right.
We have market valuations operating under this assumption of a frictionless, almost utopian digital transformation.
Yeah.
But the physical economy, the one that actually has to house and power that digital infrastructure, is quietly but severely choking on geopolitical reality.
Welcome to another financial analysis deep dive from the Two and Compound team. If you are sitting there today trying to reconcile how the S&P 500 can be pricing in this imminent world-altering AI productivity miracle while everyday physical supply chains are fracturing under immense stress, well, you are exactly in the right place.
Yeah, you are the third intellect in the room today. And we know you appreciate a nuanced, rigorous look at these markets without, the impenetrable Wall Street jargon.
Exactly. We are not here to hype up a tech cycle, and we are certainly not here to sell doom. We are just here to connect the dots.
And we have an incredibly dense stack of institutional intelligence to unpack for you. We're pulling from proprietary research, economic models from Man Group, Morgan Stanley, Goldman Sachs, the International Monetary Fund, the Bank of Korea, and Shadow Dynamics, plus some really key corporate advisories from Accenture and Fidelity.
Yeah, it's a massive stack. So the mission for this deep dive, like the central thesis we have to answer for you today, is really this. Are we genuinely on the verge of a historic, world-altering AI productivity boom that's going to reshape human output? Or are we basically sleepwalking into a historic capital expenditure bust, one that's about to be violently exacerbated by this fragile physical autonomy?
To answer that, I mean, we have to start with a macro reality check.
We have to.
We have to look at the dual shock that is currently hitting the global system, because you cannot possibly understand a multi-hundred-billion-dollar tech capex cycle in isolation. You really have to understand the macroeconomic environment that is supposed to be funding it.
Right. The physical economy is the bedrock. I mean, if the foundation is cracking, it really doesn't matter how spectacular the digital penthouse looks.
Great way to put it.
So let's start with the baseline of global growth. Let's look at the IMF's, the International Monetary Fund's, latest global growth downgrade. They recently cut their 2026 forecast down to 3%.
Now, let's be clear about that number for a second. 3% is not a recession.
No, not at all.
It is below the 2024 to 2025 average, which was about 3.5%, but technically, it still represents expansion. I mean, the global economy is still growing. It's just doing it slower.
Right, so the headline number is 3%, and on a Bloomberg terminal, that might look like a mild deceleration, like a soft landing maybe? But the mechanics behind that number, the actual assumptions built into that 3% model, are where the real story lives.
And quite frankly, where the real danger lies. We have to look at this brilliant piece of reporting from Silicon Canals that dug into the footnotes of the IMF's projection. They highlighted this glaring, almost terrifying vulnerability in the mathematical model.
Yeah, I read this part of the notes, and it genuinely made me do a double take.
It absolutely should.
Yeah.
Because the entire 3% growth forecast rests on one highly precarious, explicit assumption. The IMF model mathematically assumes that the Strait of Hormuz will begin reopening to normal, unimpeded commercial traffic by mid-July.
Wait.
And that it will return to a completely pre-war state of operations by March.
Which is completely detached from reality. I mean, it's like predicting a beautiful sunny day for a family picnic by mathematically assuming the Category 5 hurricane sitting right off the coast will just, I don't know, politely vanish because your spreadsheet requires it to.
Yeah, exactly.
When you actually read the fine print in that Silicon Canal's breakdown, you realize the IMF is making a massive, almost reckless assumption. I mean, missiles were literally landing on commercial freighters while the IMF report was at the printer.
Right.
Silicon Canals rightfully points out that the word assumes is doing an impossible amount of heavy lifting in that document. If you strip out the assumption of a neat diplomatic resolution in the Middle East, a resolution that currently has zero geopolitical momentum, by the way, that 3% growth forecast completely collapses.
It does. It totally falls apart. But, we also have to understand why a multilateral institution like the IMF operates this way. They are structurally constrained.
How so?
Well, they cannot publish a baseline economic projection that explicitly admits its central geopolitical assumption is essentially a coin flip. Or worse, structurally unlikely. Doing that could trigger the exact sovereign debt crises they exist to prevent. So they're forced to model a return to mean stability.
Okay, I get that. But you and I, and, the listener managing a portfolio or trying to run a business, we don't have the luxury of ignoring the physical choke points just to protect diplomatic feelings.
No, we definitely don't.
When 41 massive cargo transits a day are dictating the global flow of energy and goods, and those transits are being severely disrupted, that friction doesn't just disappear. It bleeds directly into corporate margins.
And that brings us perfectly to the advisory brief that Accenture just sent out to CEOs, which really frames this whole thing not just as a geopolitical event, but as a corporate balance sheet crisis.
Yeah, let's get into the Accenture brief, because their warning is stark.
Very.
Yeah.
They are telling corporate leaders that the Iran war and the broader Middle East conflict are no longer just acute temporary energy shocks. This isn't just a brief spike in oil prices that you hedge against for one quarter and then forget about.
Right.
It has mutated. It is now a prolonged affordability and margin challenge that will define the next several years of corporate performance.
So Accenture details what they call a two-sided P&L squeeze, hitting companies specifically for fiscal year 26 and fiscal year 27. Let's really break down the mechanics of that squeeze, because this is exactly where the macro theory hits the reality of everyday business operations.
Okay, let's look at the profit and loss statement. On the supply side one of the squeeze, you have elevated inflation driving up structural input costs.
Like what?
We're talking about energy to run factories, the cost of packaging materials, and critically, logistics, like rerouting a massive container ship around the Cape of Good Hope because the Red Sea and the Strait of Hormuz are just too dangerous. That adds thousands of miles to a journey.
Which means massive fuel costs.
Massive fuel costs, skyrocketing insurance premiums, and it just creates immense freight volatility. The cost to simply put a fiscal product on a shelf is surging.
Right, so the cost to make and move the widget has gone way up. That's side one.
Precisely. Then you flip over to the demand side of the P&L. That same elevated inflation, the higher cost of energy, the higher cost of food, is weighing really heavily on consumer spending.
Right, the middle income shopper is down trading.
Exactly. They are buying the store brand instead of the premium brand.
Right.
Or they're just delaying discretionary purchases entirely. So corporate executives are facing this brutal vice grip. Their costs to produce and ship goods are rising sharply, precisely at the very moment their customers are losing the purchasing power to absorb higher prices.
They can't pass the costs along without destroying their demand.
Exactly.
And the timeline for this squeeze is crucial to understand. I mean, Accenture is explicitly telling CEOs that the old playbook is dead. The broad-based immediate shock responses, like just freezing hiring for a month, holding the line on prices, and hoping for a swift normalization next quarter, those are no longer viable strategies.
No. The base case for the global economy is now lingering, chronic uncertainty. In fact, Accenture warns that the risks for fiscal year 27 could actually be substantially larger than fiscal year 26.
Which seems counterintuitive, right? Why would 2027 be worse if the initial shock happened earlier?
It has to do with commodity pass-throughs. Take agriculture, for example. The disruptions in energy and shipping heavily impact the production and transport of fertilizer. But you don't feel the economic impact of a fertilizer shortage today. You feel it in the next harvest cycle. And then you feel it in the packaged food prices 6 to 9 months after that.
Wow.
Yeah, the lag effects haven't even fully materialized yet.
Okay, but I want to push back a little here. Because we cannot just paint a universally apocalyptic picture if the data shows nuance. We really have to look at the global economic scenarios modeled by Aberdeen. Because their analysts point out that the global economy has actually displayed surprising almost baffling resilience to successive shocks over the last 5 years.
That's a fair point. They do make a very strong case for resilience. I mean, if you look at the trajectory from the initial tariff and trade wars through the global pandemic lockdowns, the subsequent supply chain crises, the land war in Europe, and now this ongoing Middle East conflict.
That's a lot.
It is. But the underlying aggregate demand has held up remarkably better than many of the catastrophic models predicted.
Right. Aberdeen's baseline suggests that while the environment definitely features structurally higher geopolitical risk and persistent inflation volatility, corporate and consumer balance sheets actually entered this period with enough buffer to absorb the initial blows.
Like excess savings from the pandemic.
Exactly. People had excess savings. Companies had locked in really low interest debt during the easy money era. The system didn't break.
It didn't break. But, as you know, a buffer is finite by definition.
Sure.
A sponge can only absorb so much water before it simply cannot hold another drop. And this is where we have to look deeper into Aberdeen's own data, specifically what they're observing right now in the bond market, because the bond market is often the earliest warning system for systemic fatigue.
Always.
And Aberdeen notes two critical shifts. First, bond term premia are rising, and second, bond equity correlations are becoming increasingly positive.
Okay, let's pause and translate those concepts, because those are heavy financial terms, but they are absolutely vital for you to understand if you are listening to this and managing any kind of retirement account or investment portfolio. Let's start with bond term premia rising. What does that actually mean in plain English?
Okay, think of the term premium as the extra compensation or the extra yield that investors demand to lock up their money for a long period of time, say 10 or 20 years, compared to just rolling over short-term one-year debt again and again.
So it's like a risk premium for the unknown. Like if I lend you money for a week, I'm pretty sure what inflation and interest rates are going to do. But if I lend you money for 10 years, who knows what the world looks like? I need to be paid extra for taking on that decade of uncertainty.
That's exactly it. For a long time during the era of stable, low inflation, the term premium was incredibly low. Sometimes it was even negative. Investors just weren't scared of the future. But now, with structural inflation and all this geopolitical chaos, bond term premia are rising sharply. Investors are looking at the massive sovereign debt loads and the physical supply chain constraints we just talked about, and they are demanding significantly higher yields to hold long-term government debt.
Which makes borrowing much more expensive for governments and corporations alike.
Exactly.
And then the second point, bond equity correlations turning positive. This is kind of the real nightmare for the traditional 60-40 portfolio, right?
It really is.
Because the whole point of holding 60% stocks and 40% bonds is that they're supposed to move in opposite directions. When stocks take a hit because the economy slows down, central banks usually cut interest rates, which makes your existing bonds more valuable. Your bonds act as a parachute for your portfolio.
That is the historical theory, yes. But when bond equity correlations turn positive, it means stocks and bonds are moving in the exact same direction.
They're falling together.
Right. When inflation is a primary threat, central banks cannot cut interest rates to save the stock market. In fact, they have to keep rates high, which hurts corporate earnings and depresses stock prices while simultaneously crushing the value of existing bonds.
So your parachute isn't a parachute anymore.
No.
Yeah.
It's just a second rock tied to your ankle.
Wow. Which tells you the market is slowly, painfully digesting the reality that the physical economy is constrained. We have this intense margin compression in the real world. Executives are literally sweating over every basis point of logistics costs. They're dealing with cautious consumers and realizing their traditional financial safety nets are failing.
Which makes the pivot to the digital economy and the AI sector specifically all the more jarring.
Jarring is putting it mildly. I mean, it is almost schizophrenic. We are pivoting from manufacturing companies literally fighting for basis points of margin on shipping routes to a sector that seemingly operates entirely outside the bounds of financial gravity.
It really feels that way.
Let's shift our focus to the AI infrastructure build-out, because this is where the money is moving in ways we have basically never seen before. The numbers from Goldman Sachs and Shadow Dynamics are, frankly, staggering.
Yeah, we are talking about the top 5 hyperscale tech companies, so the major cloud providers and AI leaders, projecting between $500 billion and $690 billion in AI capital expenditure in the year 2026 alone.
Let's just sit with that number for a second. Up to $690 billion in a single year.
To contextualize that scale, $690 billion is roughly 1.5 times the 2025 capex level, which was already considered a historic anomaly. It is an astronomical sum.
It's massive.
And we have to remember, this isn't just software. We aren't talking about lines of code being written by some guys in a dorm room. We're witnessing the construction of a deeply physical edifice.
That's the irony, isn't it? Like, people think of the cloud as this ethereal thing, but the cloud isn't in the sky. The cloud is a massive concrete building in Virginia or Ohio.
Precisely. This $690 billion is buying millions of highly specialized processors. It's buying hundreds of thousands of kilometers of physical fiber optic cabling. It's funding massive industrial liquid cooling systems just to keep the servers from melting down.
And the power demands.
Oh, the power generation demands literally rival those of mid-sized sovereign nations. It is a heavy industry build-out that is basically masquerading as a tech boom.
Which brings up, the most important question in finance. How on earth is a build-out of that magnitude actually being financed? I mean, if the macro environment is tightening and consumer demand is under pressure, where's the cash coming from?
That is the multi-hundred-billion-dollar question. And the Bank of Korea released a fascinating and frankly deeply concerning analysis of this exact AI semiconductor cycle. They zeroed right in on the financing structure.
And it's significant that this warning is coming from the Bank of Korea, right? Because South Korea's entire national economic foundation relies heavily on the export of memory chips.
Exactly. If anyone has an incentive to be a cheerleader for a multi-year semiconductor supercycle, it is the South Korean Central Bank. Yet, their analysis is remarkably cautious.
What did they say?
They explicitly compare the current moment not to some new industrial revolution, but to the late 1990s telecom bubble.
Ouch. And they highlight a specific, terrifying metric regarding corporate cash flows.
They do. The Bank of Korea points out that the operating cash flow of these massive tech companies can no longer cover this level of capital expenditure.
Okay, let's break down operating cash flow and why this ratio matters so much. So operating cash flow is essentially the actual cash a company generates from its normal day-to-day business operations.
Right, the actual money coming in.
Right. It's the money coming in the door from selling software subscriptions or cloud storage or digital ads, minus the cash operating expenses. It's basically the lifeblood of a sustainable business.
Exactly. And historically, for these tech giants, capital expenditure like buying servers, building data centers, might consume around 25% of their operating cash flow.
Which leaves 75% of their cash free.
Yes. 75% left over to pay dividends, buy back stock, acquire other companies, or just build a massive war chest. It was an incredibly lucrative, cash-rich model.
But the Bank of Korea notes that this ratio has fundamentally broken.
It has absolutely soared. The ratio of capex to operating cash flow for these hyperscalers has approached nearly 100%.
Wow.
Everything they earn from their core business is being immediately plowed back into buying AI infrastructure. There's essentially no free cash flow left over.
So what happens when a company needs to spend, say, 120% of its cash flow?
Well, it has to borrow. Starting in the second half of last year, the Bank of Korea noted that these companies had to significantly reduce their share buyback programs, which, by the way, had been a major driver of their stock price appreciation.
Oh, for sure.
And they had to start issuing massive amounts of corporate bonds just to fund the data center build-out. They are actively taking on debt to buy chips.
And the bond market is noticing. I mean, the Bank of Korea analysis points out that we're even seeing the credit default swap spreads of some of these companies beginning to widen.
We should definitely translate that indicator as well for the listener.
Please do. What is a credit default swap, and why does a widening spread matter?
Okay, think of a credit default swap, or a CDS, as basically a fire insurance policy on a company's debt. If you own a bond issued by a tech company, and you are worried they might go bankrupt and default on that bond, you can buy a CDS.
It's a hedge.
Right. It guarantees you will get your money back if the company defaults. The spread is simply the price of that insurance policy.
So if the spread is widening, it just means the insurance is getting more expensive.
Exactly. And insurance only gets more expensive when the market smells smoke. If the CDS spreads on major tech companies are widening, it means sophisticated institutional investors are willing to pay more to protect themselves, because they think there's a possibility that these massive companies might actually default on the debt they're issuing to build these AI data centers.
It's a subtle but highly significant red flag in the credit markets.
A massive red flag. When a central bank that is deeply tied to the semiconductor industry spends a significant portion of its report detailing the fragility of the sector's financing structure, you have to pay attention.
Definitely. But, the fragility becomes even more apparent, almost surreal, honestly, when you examine how these hyperscalers are actually operating with each other. This is where we get into the analysis from Man Group on what they call the closed recursive financing loop of the AI bubble.
Yeah, this is perhaps the most critical dynamic to understand in the entire AI ecosystem right now. Man Group details how the major players, companies like Microsoft, Amazon, Meta, Google, OpenAI, Anthropic, they are not just competing with each other.
No.
They are simultaneously acting as suppliers, customers, and investors to one another in a tightly closed loop.
I read this section of the Man Group report, and I tried to come up with an analogy to explain it. It is honestly like a group of incredibly wealthy friends who own an art gallery.
Okay, I like where this is going.
They want the world to think the art in the gallery is invaluable, so they start buying each other's artwork using monopoly money.
Right.
Person A buys Person B's painting for 10 million monopoly dollars. Person B uses that exact same monopoly money to buy Person C's sculpture.
And the numbers just go up.
Exactly. On paper, the gallery's transaction volume is exploding, the valuations are sky high, everyone feels incredibly rich, but the problem is no actual external cash has entered the room. Eventually, the landlord of the gallery is going to knock on the door and demand rent in actual hard currency.
That is a remarkably accurate analogy for what Man Group calls off-balance sheet leverage. Let's walk through how this works in the AI sector with cloud compute credits, because that's the monopoly money here.
Yes, let's trace the life of a cloud credit, because this is where the illusion of revenue is created.
Okay, imagine a major hyperscaler, a massive cloud compute provider. They want to ensure a hot new AI startup uses their infrastructure, right? And they also want a stake in that startup's potential upside. But instead of investing $1 billion in actual cash, the hyperscaler invests $1 billion worth of cloud compute credits.
So they literally just give the startup a coupon that says, good for $1 billion of server time on our network. No actual cash has left the hyperscaler's bank account.
Correct. But the startup now has a $1 billion valuation boost based on this investment. The startup then turns around and uses those credits to buy server time and train their AI models on the hyperscaler's network.
And here is the magic trick. How does the hyperscaler record that transaction when the startup redeems the coupon?
The hyperscaler books it as revenue.
Even though it was their own credit.
Exactly. It makes their top-line revenue growth look absolutely spectacular to Wall Street. Wall Street sees surging cloud revenue and rewards the hyperscaler with an even higher stock valuation.
Which allows them to issue more debt.
Yes. That higher valuation allows the hyperscaler to issue more debt at favorable rates, which they use to build more physical data centers so they can issue more compute credits to more startups.
Yeah.
And the cycle continues.
The demand signal is entirely circular. It is largely divorced from the broader external consumer market. The hyperscalers are essentially just funding their own revenue growth.
It's a closed loop.
So the vital question becomes, what happens when one major player in that loop blinks? I mean, if the revenue growth of the entire AI cluster relies on this reflexive, self-referential demand, a slowdown by a single firm, say, one startup runs out of credits and actually goes bankrupt, or one hyperscaler decides to tighten its belt, could trigger a cascading collapse in revenues across the board.
It is the very definition of systemic fragility. And that recursive loop leads us to the fundamental economic test of this entire era.
Which is?
If the capex is massive $690 billion, but the financing is circular and the revenue is heavily subsidized by cloud credits, we have to look outside the tech sector. We have to look at the real economy. Is artificial intelligence actually transforming the broader macroeconomic landscape yet? Or is it just an illusion hiding in the data?
And that brings us to Citrini research and this deeply unsettling concept of ghost GDP, which Man Group extensively analyzed in their report. Citrini wrote a theoretical scenario set in the near future, around 2028, to illustrate what a highly localized AI productivity miracle would actually look like for the rest of us.
It's a thought experiment, but a very, very grounded one. Imagine a massive, state-of-the-art GPU cluster built in a remote field somewhere in North Dakota.
Okay, picture the warehouse again.
Right. And this single facility suddenly becomes capable of generating the exact cognitive and administrative output of 10,000 Midtown Manhattan office workers. It can do the legal document review, the financial modeling, the marketing copy, the customer service, all of it, flawlessly and instantly.
From a purely macroeconomic top-down perspective, this looks like an absolute miracle. Total productivity explodes. The corporate margins of the companies utilizing that GPU cluster just surge because their labor costs just drop to near zero.
The economy falls apart.
Exactly, because you have to trace the cascading effect of those 10,000 displaced Manhattan workers. Let's really look at what happens.
It's grim.
Those 10,000 people are no longer receiving a paycheck. First, they stop buying $15 salads, so the local lunch spots go bankrupt. They stop taking the subway, so municipal transit revenues collapse. They can no longer pay their exorbitant Manhattan rent, so the commercial and residential real estate markets implode.
Right.
They cannot buy groceries from consumer packaged goods companies. They cannot buy cars. They cancel their streaming subscriptions.
Srini calls this ghost GDP. It is economic output that looks incredible on the national accounting ledgers. I mean, the AI is producing massive value, but the wealth generated never actually circulates through the real economy.
It's trapped.
It's totally trapped.
Yeah.
The output exists, but the consumption mechanism is broken because labor has been removed from the equation.
The ghost GDP scenario is a fascinating, if, terrifying theoretical extreme. But Man Group didn't just want to rely on thought experiments. They wanted empirical data. They wanted to test if we are actually approaching that kind of economic singularity today.
So to do that, they revived and updated a diagnostic framework created by the Nobel laureate economist William Nordhaus back in 2021.
Tell us about the Nordhaus tests.
Nordhaus is a pioneer in modeling long-term economic growth. He designed 6 empirical, data-driven tests to detect if an economy is entering a regime of explosive, self-sustaining growth driven by information technology. It's essentially an early warning system for an economic singularity where machine intelligence overtakes human labor as the primary driver of output.
And Man Group ran these 6 Nordhaus tests with a decade of new data, bringing the model right up to the present day, which includes this massive first wave of large language model deployment.
And the results are incredibly telling. Out of 6 tests designed to prove an AI productivity miracle is happening, only 1 clearly passes.
Just 1. And we need to look closely at what that one passing metric is. Test 1 measures capital's share of income.
Right.
It looks at the proportion of total economic income going to profits, rents, and interest, which go to the owners of capital, as opposed to wages, which go to labor.
And what does the data show?
The test passes with flying colors. The capital share of income has risen significantly, moving from roughly 31% in the early 1990s to about 40% today.
That trend line is entirely consistent with the dynamic where machines and algorithms are increasingly replacing human labor, allowing the owners of the technology to capture a much larger slice of the economic pie.
Okay, but as the Man Group report rigorously points out, passing a necessary condition is not the same as proving the case.
No, it's not.
That rising capital share is certainly consistent with an AI takeover, sure, but it is equally consistent with 3 decades of very mundane, very human economic trends. It is consistent with rising corporate monopoly power, the globalization of supply chains outsourcing labor to cheaper markets, and the severe decades-long decline in union density. The raw data cannot distinguish between an advanced AI algorithm taking over and just traditional corporate consolidation squeezing workers.
Exactly. Test 1 is ambiguous. But the most damning result from the Nordhaus update is Test 2.
Test 2 is the one that really matters.
It is. Test 2 measures total factor productivity.
Let's translate total factor productivity, or TFP, for the listener. What is this magic sauce of economic growth?
So total factor productivity is essentially a measure of efficiency. It is the portion of economic growth that cannot be explained simply by throwing more capital like money or machines or more labor like workers at a problem.
It measures how smartly we work.
Exactly. It measures how smartly and efficiently we combine those things. If TFP is growing, it means innovation, technology, or better processes are allowing us to get more output from the exact same amount of input.
So, if AI is driving a genuine, world-altering economic transformation, we should see total factor productivity on a sustained, explosive upward trend. We should be getting massively more efficient as a society.
We should. Instead, the test is a clear, unequivocal failure.
Right.
U.S. productivity growth is currently stuck at around 0.88% per year.
0.88%. I mean, that's practically statistical noise.
It is abysmal. To put it in perspective, that 0.88% is well below the peak productivity growth we saw in the late 1990s and early 2000s during the early internet boom when basic search engines and email were being integrated into workflows.
So we have a $690 billion capex build-out happening this year. Hyperscalers are issuing massive debt to buy chips, but productivity, how efficiently the broader economy is actually functioning, is functionally stagnant.
Completely flat.
This completely challenges the standard optimistic defense of tech disruption that you always hear from Silicon Valley.
Yeah, the traditional argument is the recycling theory. It posits that yes, technology displaces some workers initially, but the massive productivity gains create new wealth and lower the cost of goods.
And then that wealth gets recycled.
Right. That new wealth gets recycled into the economy, creating higher demand for new services, which creates new industries and ultimately higher wages for everyone. It grows the pie.
And historically, over the last 100 years, that recycling argument has largely been correct. Cars put buggy whip makers out of business, but created millions of jobs in manufacturing, road construction, and logistics.
History largely supports it, yes. But Man Group argues that both the Citrini doomsday scenario of total societal collapse and the standard Silicon Valley recycling defense are missing the most likely and perhaps most insidious historical parallel.
Okay.
They argue we are entering an Engel's pause.
Let's unpack the Engel's pause. We really need to spend some time on this because
Yeah.
if Man Group is right, this explains the next 20 years of our lives. Tell the story of the original Engel's pause.
We have to go back to the early stages of the British Industrial Revolution, spanning roughly from 1790 to 1840. This was an era of unprecedented technological disruption.
The original one.
Exactly. The invention of the mechanized loom and the steam engine fundamentally transformed manufacturing. Output per worker surged. The sheer volume of textiles and goods Britain produced exploded.
So GDP was going through the roof.
It was. But here's the critical part. Real wages for the working class stagnated for half a century. 50 years.
50 years without a wage increase.
None. The productivity gains were entirely real, but they were incredibly slow to circulate through the broader economy. All the immense new wealth generated by these mechanized factories accrued almost exclusively to the owners of the capital, the factory owners, the industrialists.
Wow.
Ordinary workers saw absolutely no improvement in their living standards, and in many cases faced brutal working conditions in the new industrial centers.
So Friedrich Engels observes this, writes about the condition of the working class, and economic historians later coined this 50-year gap between productivity and wage growth the Engels pause.
Exactly.
It wasn't a failure of aggregate economic growth. Britain became incredibly wealthy. It was a structural failure of distribution.
Exactly. You can have record economic output, surging corporate profits, and completely anemic consumer demand and stagnant wages, all simultaneously. Man Group suggests AI might not destroy the economy, but it might recreate the conditions of 1790, where the owners of the algorithms capture all the gains for a generation, while the middle class stagnates.
Okay, I hear the historical parallel, but I want to push back on this a bit.
Sure.
I push back on the extreme 38% equity sell-off narrative that Citrini models, and I even question if we need this grand historical Engels pause narrative at all. Do we really need to invoke societal transformation? Isn't it much more plausible that what we are seeing is just a classic, mundane 2001-style tech investment bust in the making?
Explain your parallel to 2001.
Think about the late 90s telecom boom. The internet was a genuinely transformative technology. It wasn't fake, but the telecom companies got way ahead of themselves. They laid millions of miles of physical fiber optic cable across the oceans and under the continents, anticipating an immediate explosion in consumer demand that just wasn't there yet.
Because people were still using dial-up.
Exactly. People were on dial-up. The capital expenditure massively outran the reality of consumer adoption. The companies went bankrupt, the stock market crashed, but the physical fiber was laid. And 10 years later, companies like Netflix and Google built empires on top of that cheap, abandoned infrastructure.
Right.
Aren't we just doing that again? Building massive AI data centers that we won't actually have the software to utilize profitably for another decade.
That is a very grounded perspective, and frankly, it perfectly aligns with the timeline laid out in the Bank of Korea's analysis.
Right.
The Bank of Korea sees the current year and 2026 as being heavily demand-dominated. Everyone wants chips, and there's a shortage.
A hype phase.
The hype phase.
Yeah.
But they warn that by 2027 and 2028, a massive wave of new semiconductor fabrication plants fueled by billions in government subsidies from the U.S. CHIPS Act and similar programs globally will finally come online.
Right. So the supply of chips catches up just as the hyperscalers realize their AI models aren't generating enough direct revenue to justify the massive debt they took on.
Exactly. As that new supply hits the market, the vulnerabilities in the closed-loop corporate financing structures we discussed earlier will be violently exposed. A traditional capex bust, where supply gluts the market and prices collapse, is arguably the highest probability near-term risk. It doesn't require a singularity or a doomsday. It just requires a standard cycle of overinvestment and misallocated capital.
But let's combine the two thoughts. What if we get the capex bust in the short term, but we do eventually enter an Engel's pause in the long term, where AI slowly but surely erodes white-collar wages without creating new middle-class jobs? If capital captures all the gains for a generation while labor stagnates, how are governments positioned to handle the fallout?
This is a huge question.
Because this is where the macroeconomic models and the regulatory reality crash into each other violently.
And this is exactly where the intelligence brief from Shadow Dynamics is so critical. They analyze what they call the sovereign fiscal cliff. Their assessment of the current global regulatory environment regarding AI is absolutely scathing.
What do they say?
They argue that Western democracies, in their rush to win the AI arms race, have effectively written the most elaborate permission slip in regulatory history for the transfer of wealth from labor to capital.
Wow, let's use the EU AI Act as the prime example here, because it is constantly touted in the press as this comprehensive, world-leading governance framework. It's supposed to be the gold standard for protecting citizens from rogue AI. It has 113 detailed articles regulating everything from biometric categorization to transparency requirements for chatbots.
Do you know how many redistributive mechanisms it contains to handle mass labor displacement?
0.
Exactly 0. It is fundamentally a product safety regulation. It dictates how the algorithm must behave to avoid bias or generating deepfakes, but it completely ignores the underlying economic architecture it is regulating.
Right.
It has no mechanism to capture the immense wealth generated by the AI and redistribute it to the workers the AI inevitably replaces.
The structural sequencing error here is just profound. Let's look at the IMF's World Economic Outlook data on this. The IMF estimates that 60% of all jobs in advanced economies are directly exposed to AI disruption. And crucially, that exposure is not in manual labor or manufacturing. It is heavily concentrated in administrative, clerical, mid-level management, and service sectors.
Let me stop you there and ask. Why does that specific concentration in administrative and clerical work matter so much from a macroeconomic perspective?
Because those sectors constitute the primary income tax base of G7 nations. Our entire modern sovereign state, the way we fund schools, roads, the military, and social safety nets, is completely predicated on taxing the income of a broad, employed middle class doing cognitive or administrative work.
Right.
If you hollow out that specific tier of employment, you don't just have angry unemployed people, you have a sovereign funding crisis.
Exactly. And the transition is being architected by a tiny handful of entities. You have roughly 6 private tech monopolies, plus the national interests of the U.S. and China, who combine control over 90% of the world's frontier AI training capacity.
It's highly concentrated.
Incredibly concentrated. These actors have zero democratic accountability to the displaced workers in Europe or Middle America. And critically, they have zero fiscal dependence on the income tax streams that their technology is actively eliminating.
It is the ultimate misalignment of incentives. The corporate actors driving the displacement are outspending the government institutions nominally responsible for managing it by an order of magnitude. Shadow Dynamics calls this dynamic the fiscal hostage state.
The mechanics of the fiscal hostage state are really alarming. If AI effectively displaces a significant portion of the administrative and service sector jobs, governments are going to face massive, sudden revenue shortfalls. And the timing couldn't possibly be worse.
Why is the timing worse now than, say, during the automation of factories in the 1980s?
Because of the debt loads and the geopolitical reality we established in Segment 1. We have to look at the Bank for International Settlements AR 2026 report. The BIS highlights that this potential collapse in the income tax base is happening exactly when governments are facing massive, historic refinancing needs for the debt they took on during the pandemic era.
The bills are coming due.
Exactly. And simultaneously, because of the geopolitical shocks, the conflict in the Middle East, the tension in Asia's sovereign requirements for defense spending are skyrocketing.
It's a perfect storm. Every G7 government is simultaneously acting as the arsonist and the fire department. They are heavily subsidizing and accelerating the development of AI in the name of national technological supremacy, essentially destroying their own tax base in the process, while failing to build any fiscal infrastructure like a robot tax or a universal basic income framework to survive the fire they are setting.
And what is truly fascinating is that the stock market is completely ignoring this structural sovereign risk.
Yeah.
Man Numeric, which is the quantitative arm of Man Group, points out that the Shiller CAPE ratio is sitting at 39.
Let's explain the Shiller CAPE for the listener, because it's important.
Please do.
CAPE stands for a cyclically adjusted price-to-earnings ratio. It was popularized by the economist Robert Shiller. Instead of just looking at a company's earnings over the last 12 months, which can fluctuate wildly based on temporary booms or busts, the KP ratio takes a 10-year average of earnings, adjusted for inflation. It smooths out the business cycle to give you a much truer picture of whether the stock market is expensive or cheap relative to its actual historical earning power.
That's a perfect explanation. And the historical context is what makes a reading of 39 so alarming.
Right.
Over the last 40 years, covering multiple boom and bust cycles, the average for the Shiller CAPE is roughly 25.
So if the long-term average is 25 and we are currently sitting at 39, the market is priced for absolute, unmitigated perfection.
Yes. A simple reversion to the mean, just returning to the historical average valuation of 25, implies roughly a 30% drawdown in equities from current levels. The stock market is pricing in a frictionless, utopian digital transition. It is completely ignoring the physical supply chain constraints we discussed in the Strait of Hormuz, the massive margin squeeze on consumers, the fragility of the corporate bond markets funding the capex, and the looming sovereign fiscal vulnerabilities.
I want to have a real debate on this, though. I want to play devil's advocate here because Aberdeen lays out different economic scenarios in their modeling, and they are not entirely pessimistic. They assign a 25% probability, a 1 in 4 chance, which is highly significant, to a true AI productivity boom.
Let's explore their boom scenario. How does it work mechanically?
In this 25% probability scenario, AI integration actually works exactly as promised. It massively boosts potential economic growth, but more importantly, it structurally lowers unit labor costs across the board. Legal services become cheaper, medical diagnostics become cheaper, software development becomes cheaper. This puts massive, sustained downward pressure on aggregate inflation. If AI structurally kills inflation, central banks can aggressively ease monetary policy. They can slash interest rates. That saves the bond market. It lowers the cost of corporate borrowing, and it creates a massive economic tailwind.
So Aberdeen is arguing that AI acts as a massive deflationary force, driving down the cost of white-collar services in the exact same way that globalization and the integration of China into the WTO drove down the cost of manufactured goods in the 2000s.
Exactly. Aberdeen's boom scenario relies on corporations successfully integrating AI into their existing workflows, augmenting human labor to make it drastically more efficient, rather than replacing it outright in a Citrini-style ghost GDP scenario. If you augment rather than replace, profit margins can widen significantly because output soars, but you don't suffer a corresponding collapse in aggregate consumer employment and demand.
That makes sense.
So, is there a world where the regulatory theater of the EU AI Act simply doesn't matter because the productivity gains are so incredibly massive they simply overwhelm the transitional friction?
It is entirely possible. A 25% probability is not negligible. If AI creates a deflationary supercycle that cures the inflation problem without requiring central banks to crush demand with high interest rates, the equity market could continue to soar. However, even if we accept the optimistic Aberdeen scenario, there is a fundamental flaw in assuming it will be frictionless.
What's the flaw?
The flaw is that even in a digital productivity boom, you still cannot escape the physical bottlenecks. The digital expansion cannot permanently outrun the physical infrastructure that sustains it. You can have the most brilliant AI algorithm in the world that perfectly augments your workforce. But that algorithm lives in a data center that requires massive amounts of baseload power generation.
Which is very physical.
Right. The servers require advanced chips that rely on rare earth minerals mined in geopolitically sensitive regions. And the finished physical products your augmented workforce designs still require physical shipping through contested waters like the Strait of Hormuz.
Right. You can't download a cargo ship.
Exactly. You just can't. The digital boom is tethered to a physical world that is currently defined by fragmentation, conflict, and constrained resources.
Which brings us to the most important part of this deep dive, the practical application of all this intelligence. We have laid out the macro geopolitical squeeze on the physical side and the massive, potentially circular digital capex bubble on the other. If you are listening to this, how should you actually be thinking about positioning a portfolio or a business strategy in this environment?
Let's synthesize the actionable takeaways directly from our sources.
Sounds good.
The most immediate and clear directive comes from Morgan Stanley's analysis of the equity markets. They make a very explicit point. This is not the time to blindly chase broad market cap-weighted tech ETFs. The era of a rising tide lifting all technological boats is over.
Because if a capex bust happens, or even just a mild deceleration in cloud credit spending, the pretenders get wiped out.
Exactly. Morgan Stanley stresses that the dispersion in performance, the gap between the winners and losers within the tech sector, is going to be massive. You need to rigorously differentiate the true AI winners who actually have sustainable, cash-generating business models from the companies that are simply riding the capex wave by supplying commoditized parts or services.
Okay, so avoid broad tech ETFs and focus on specific cash generation. What about the fixed income space? For investors looking at bonds, where is the safety or the opportunity?
In the fixed income space, Morgan Stanley suggests looking at asset-backed financing that is strictly tied to contracted AI infrastructure. If you are lending money to build a data center, you want that debt backed by a rock-solid, multi-year lease agreement from a major player, not a speculative startup.
Right, you want the landlord's position backed by a good tenant.
Furthermore, they see value in the unsecured investment-grade credit of the highly rated, cash-rich hyperscalers. The logic here is simple. Even if the AI cycle slows down, companies like Microsoft or Google have the fortress balance sheets and the diverse legacy revenue streams to comfortably service the debt they are issuing. You avoid the debt of the mid-tier players who are over-leveraging themselves to compete.
Now let's pivot to the equity side and look at the broader economy. Man Group and Accenture both point to a critical vulnerability that has nothing to do with tech stocks directly, but is a consequence of the macro environment. They are flashing a massive warning sign regarding consumer businesses exposed to middle-income earners.
This ties directly back to the Engel's pause and the two-sided P&L squeeze we discussed earlier. If we're entering a prolonged period where AI suppresses middle-class wage growth, or even if we just face a prolonged period of inflation-driven margin pressure, as Accenture warns, the discretionary purchasing power of the middle class is going to evaporate.
So if you are analyzing a business that relies on the middle class buying a new car every 5 years, or taking a discretionary vacation, or buying premium branded clothing, those businesses are highly exposed. Their customer base is being squeezed by inflation on one side and potential wage stagnation on the other.
Exactly. The polarization of the consumer market will accelerate. Luxury goods catering to the capital-owning class might thrive, and deep discount retailers catering to strict necessities might thrive. But the middle gets completely hollowed out.
Finally, we need a metric. We need a dashboard indicator for the listener to watch. Fidelity provides a vital metric for tracking the true health of the AI boom over the next 18 months. They advise investors to keep a relentless focus on cash flows versus reported earnings.
This is the antidote to the cloud credit illusion. The bubble starts to lose its fundamental justification when the operating cash flows that companies report stop exceeding their reported net income.
Because net income can be manipulated by accounting tricks, recognizing cloud credits as revenue, or changing depreciation schedules on servers, but cash flow is hard cash in the bank.
Precisely. You have to monitor aggregate profit margins and cash flow statements closely to see if these massive $690 billion investments are actually generating real, non-circular, external cash returns from the broader economy. If the cash isn't there, the narrative breaks.
The warning system is quiet, but if you know where to look, it is running with blaring red lights. We are watching the operating cash flow ratios of the hyperscalers. We are watching the total factor productivity numbers to see if the economy is actually getting more efficient. And we are literally watching the daily transit counts of cargo ships through the Strait of Hormuz. The intersection of these three metrics, financing, productivity, and physical logistics, will unequivocally dictate the next decade of market performance.
The tension between the infinite, frictionless promise of the digital world and the stubborn, unforgiving constraints of the physical world has really never been more pronounced in economic history.
Which leaves you, the listener, with one final, slightly provocative thought to mull over as you look at your own investments this week. We have been conditioned by history to always picture the end of a tech bubble as a spectacular cinematic crash. We think of the dot-com bust, with pets.com going to zero overnight and a spectacular realization that the technology failed to deliver on its promise. But based on the intelligence we unpacked today, what if this time is different? What if the AI bubble doesn't end with a loud bang? What if it deflates quietly, slowly? Not because the algorithms weren't smart enough or because the tech wasn't real, but because the boring physical realities of the world simply intervene. What if the surging cost of baseload power generation, the endless shipping delays through contested straits, the spiking insurance premiums on cargo, and the absolute mathematical limits of corporate debt simply quietly drain away the capital required to sustain the digital illusion?
It is a sobering realization. The future isn't just written in code. It is, and always will be, strictly constrained by copper, cargo ships, and cash flow.
Thank you for taking this deep dive with 2 in Compound. Keep your eyes on the data and keep watching the physical world.